Now, the next idea is called break even. And break even is the point where your business's total revenue equals its total expenses since opening for trade. So it is possible 12 months after starting a business to be spending $10,000 a month and to be making $20,000 a month. And the question is that business profitable? On a monthly basis, yes, they brought in more than they have spent. On a yearly basis, let's say they've been spending $10,000 a month for a year, making zero revenue. So they've already spent $120,000 and they just made $20,000. In the total calculus, they're still $100,000 in the hole. Break even is the point when you look at all of the expenses and you look at all of the revenue. Break even is that magic point where total revenue equals total expenses. You make 1 cent more than that, you are profitable, right? So break even, you can think of as the threshold of profitability. If you are not at or above the break even point, you are not a profitable business. And so that's where the business starts being a net creator of wealth instead of being a net consumer of wealth, which is particularly important when you are in the startup process, right? Most businesses aren't profitable from the very first day. There's an initial period of investment that has to happen in order for the money to be made later. So calculating your break-even point is very, very motivating and really helps you make some decisions, particularly when it comes to things like overhead. Because the less you spend to get to the point of initial revenue, the faster you break even. The faster you break even, the more quickly your business is profitable.
Break even. Questions for reflection. What is your break-even point? Have you calculated it? Are you moving closer to break even or sinking deeper into debt?
All right, amortization. Amortization is the process of spreading the cost of a resource investment over its estimated useful life, which is very, very valuable when you think about buying really expensive things that you pay for up front, and you're trying to account for, is this going to be a worthwhile purchase for us or not? So let's say you have an idea for a product, and that the production of that product is going to require a manufacturing line that costs $1 million. And you expect, based on the research you've done, based on the initial selling that you've done, based on the distributors you've talked to, you expect to sell 1 million units of that product, and you expect the manufacturing line to be able to produce that 1 million units. When you're doing your calculations, you still have to pay the money up front, right? That's never going to change. But you can say from a cost of goods sold basis, my production line is going to absorb $1 of revenue ultimately from this company. So if I sell the product for $20 and I have marketing costs, I have production costs, there's going to be a little line that says $1 for production, manufacturing line in that calculation. So it is a fictional number. It's done for analysis. It's this big expensive thing that I bought. How long am I going to be able to use it? And when I divide the total cost by the useful life of that asset, that gives me a number that's dollars per unit for the estimated life. Now, it's important to recognize that in calculating an amortized cost, you are making a prediction about the future. And predictions about the future are notorious for not being completely accurate. So if you tool up this production line and it's only able to produce 2,000 units before it breaks, the true cost of that production line per unit is going to be higher than you expected it to be. So it's an estimate based on a prediction that helps you do that initial calculation to see if an investment in something like a production line makes sense. You just have to realize the drawback. You're making a prediction that may or may not be true, may be better or worse than you expect.
In what case would it not make sense then to make the investment?
So an estimate of the useful life may be really, really low. So let's say it's $1 million and you only expect for the line to be able to produce 10,000 units before you need to invest more, right? So in that case, the cost of your manufacturing would be way higher than what you would be able to sell the product for in the end, and it would absorb any chance of profit that you would have. So if you're doing an analysis over time, it's taking one big thing and dividing it over a long period of time.
Amortization. Questions for reflection. Does your business require expensive investments? By making this investment, can you do things you otherwise couldn't do? Assuming your estimates are accurate, what's the per unit amortized cost of the investment?
Couple more ideas and then we will go to the human mind. Purchasing power is the sum total of all the liquid assets a business has at its disposal, including the money it has access to. So think of things like credit lines. That is money that is available for you to spend. And the more purchasing power you have, the more options you have at your disposal. So purchasing power is what you use to pay your overhead. So all of your fixed and variable costs come out of purchasing power. Now, when you run out of purchasing power, which includes all the cash you have on hand and all the credit you have at your disposal, that is the business definition of game over. Zero purchasing power equals zero business. And so it's really important to keep track of, as a business owner or a business operator or an entrepreneur, how much purchasing power do you have at your disposal? And even doing things like opening up a line of credit that you plan to never use in case you need it, because by the time you need it, you're probably not going to be able to get it. So keeping active track of how much cash do I have on hand, how much lines of credit or loans do I have available to me right now, managing that actively is in your best interest. You never want that to even come anywhere close to zero if you can afford it. So your job as the owner is to make sure you don't run out of purchasing power.
Purchasing power. Questions for reflection. How much purchasing power do you currently have at your disposal? Have you used it all, or do you have reserves to draw upon if necessary? What could you do to increase your total available purchasing power?
Now, part of how you do that is something called the cash flow cycle. And the cash flow cycle is the idea that money flows into and out of a business in predictable ways. So a receivable is a promise of payment you've received from somebody else, right? You're providing value to them. They promise to pay you, either now or at some point in the future. So receivables are great because they feel like a sale, feels like cash in the bank. But the trick is the cash is not in the bank until the cash is in the bank. So the promise has to be fulfilled. They have to cut the check. The check has to be deposited until you actually have that purchasing power. You can't run a business on IOUs. There have been plenty of businesses in the history of the world that have closed with $10 million of receivables on the books. Now, a debt or a payable is a promise you make to pay somebody else at a later date. So the kind of the opposite, right? You've promised to pay somebody, but you haven't paid them yet. But you need to at some point in the future. It's helpful because the later you pay, the more cash and the more purchasing power you retain until you cut that check. So if you want to increase the purchasing power of your business, you have a couple options. You can collect your receivables more quickly and pay your payables more slowly. Because by getting money immediately, and by paying it out slowly, you have more cash at any given point in time at your disposal. And this is where you get into financial engineering types of things, like maximizing that float between payables and receivables and using that to do crazy other stuff. There can be some benefits to that if you are in a short-term cash crunch and you have to maintain some purchasing power or you reach the game over phase. However, the more complicated things you do to manage your cash, particularly in the form of not paying people, the more likely it is you're going to find yourself in trouble at some point down the road. So it can be a useful short-term tool to get out of a bad situation, but as a long-term tool, it increases the probability you're going to get in trouble. So maximizing your cash position is the best way to make sure you maintain your purchasing power and you don't get into trouble by not paying people. This is the business equivalent of having an emergency fund. a pool of cash or operating capital that you are sitting on. That account is sole purpose is to provide purchasing power when you need it. And so just like from a personal finance perspective, it's great for you to have 3 months, 6 months, 12 months worth of living expenses sitting in a bank account to be used if necessary. Businesses operate on the same principle. It is optimal to have, from a flexibility and a resilience standpoint, it's optimal to have some cash waiting on hand just in case, because you never know what's going to happen.
The cash flow cycle. Questions for reflection. Is it possible to strengthen your cash flow by collecting your receivables earlier, paying creditors later, or reducing your overhead? Can you increase your available purchasing power by opening a line of credit or securing other forms of financing for use if unanticipated events occur?
Very important idea that we will come back to over and over and over again, which is called opportunity cost. Opportunity cost is the value you're giving up by making a choice, any choice. So by doing option A, you are giving up the benefits of option B, and option C, and option D, and all of the other things that you could be doing with your time or energy of resources, aside from the thing you're already doing. And this is related to the idea that we talked about earlier of next best alternative. So if you go work for one company, you can't work for another company. You may not be able to start a business. There may be other potentially more valuable things that you could be doing. And the opportunity cost of a decision is the cost of the next most valuable thing that you could be doing. Now, the opportunity cost is important because it's hidden. And as we'll talk about in the human mind section, things that are hidden or things that aren't visible are things we tend to undervalue. So a lot of times, people will be working at a dead-end job, not making a whole lot of money, not having a really good time with their life, not fully realizing that by spending their time there, they're giving up all of the other things that they could potentially be doing with their time and energy that would be more rewarding. So part of opportunity cost is to realize that because it's hidden, we have to actively remind ourselves to look for it. And when you start looking for it and you start to evaluate the decisions that you're making versus what you're giving up to make them, all of a sudden you start making better decisions overall. On the flip side of that, it is possible to completely obsess about opportunity cost and mentally keep track of the billions of things that you could be doing that you're not doing right now that may hypothetically be better and drive yourself nuts.
This is easy to calculate for money.
Yes, but not for time and not for energy and not for satisfaction.
The same way.
And the important thing to remember is opportunity cost is a present tense calculation. You can't go back into your past and choose to do something different. The future, in a sense, is unknowable. You can have some principles about how you will choose to do things in the future, but ultimately all you can look at is how am I spending my time and energy and money right now, and are there other things that I am aware of right now that may be a better investment of that time or energy and money. That's it. On the personal and the subjective level, like for me, following newspapers and network television news and all of these things can be a way to spend a lot of time, to spend a lot of energy, to produce nothing because I don't have any control over what's going on. So for me, one of the choices I make is not to pay attention to those things and invest my time and energy and money in other things that are ultimately more rewarding. So you can make decisions like that, just like you can make a decision about working for company A versus company B because they pay you more, or starting company A versus company B because company A looks like a more promising thing in the long run. So the first part of opportunity cost is really just noticing that it's there in the first place. And once you start noticing, you start making better decisions.
Opportunity cost. Questions for reflection. Examine your current investments of resources, time, and energy. Are there opportunity costs that you haven't considered? What are some potential options that may be better investments?
A financial concept that's related to opportunity cost very closely is time value of money. And a very simple way to describe time value of money is $1 today in your pocket or in your bank account is worth more than $1 tomorrow. And calculating the time value of money is a way of making choices when handling your money in the face of opportunity cost. Because how much valuable $1 today is worth versus tomorrow depends on all of the things that you could do with that dollar as it sits in your pocket right now. So if there's nothing else better that you could do with $1, if you have no other options, then time value of money doesn't exist. But if you have, let's say, a business that you own or control, and by investing an additional dollar in that business, you can make 20, that's a really big opportunity cost of spending that on a latte versus investing it in the business. So the absolute, and this is just an equation, not going to go into the details immediately. It's actually in the textbook for the HP 10B calculator. It's also on Wikipedia if you want to look it up. But that's the basic idea. $1 today worth more than $1 tomorrow. How much more depends on what else you would do with that dollar. That's pretty much it. And so the real point of thinking along these terms is it's a financial way of thinking about opportunity cost. So you can use time value of money calculations to look at a whole bunch of different alternatives across different time scales with different time periods and different variables and triangulate yourself into a way of figuring out which looks to be the most promising opportunity right now.
Time value of money. Questions for reflection. How can you use the time value of money to make smart decisions about where to invest your limited resources? What is the value of $1 in your pocket today versus a year from now?
Compounding. Compounding is the financial equivalent of accumulation. So compounding is the accumulation of a gain over time. And a way to illustrate this is, let's say you invest a certain amount of money in a bank account, and that bank account pays you interest. So for putting the money in that bank account, you are going to keep the number simple, 10% interest, which would be awesome to get right now, but let's keep it simple, right? So let's say you put $1 million in this bank account. After the first year,
We'll live on it.
yeah, after the first year, how much money are you going to have in your bank account? $1.1 million, okay? After year 2, how much are you going to have in your bank account? $1.121 million, right? Because the interest is calculated on the new amount of money you have. So what you see is when you have this cycle of adding interest and adding interest and adding interest, the account becomes more and more and more and more valuable, exponentially more valuable over time. So compounding is important because it's one of these things that our minds tend to overvalue because it involves advanced multiplication that is difficult to simulate intuitively. But if you continue this cycle over a period of, let's say, 30 years or 40 years, the counterintuitive thing is, by the end of that 30 or 40 years, the interest or the results of the last compounding are probably going to be more in absolute than the initial amount of money you put in the first place, right? So it's one of those things that, in the end, something like an 8% compound annual growth rate doesn't sound like a whole lot. 8% compounded over 30 or 40 years for a significant sum of money ends up being a massive, massive amount. So when you see these businesses that have come out of nowhere and in a couple of decades are the behemoths of their industry, chances are they've been benefiting from effectively an internal compound annual growth rate. Every dollar that they make, they have a way of investing that dollar in making 20 or 100, and it just compounds and compounds and compounds, and all of a sudden this business is worth billions of dollars. That's how it happens. It's not rocket science, it's not magic, it's math. So the real trick is creating a business system that's able to turn reliably $1 into $5 or $10 or $15 or $20, and then to do that over and over and over again for a period of years. And you have a company worth billions. That's how it works. The trick is to be patient.
Compounding. Questions for reflection. Are you reinvesting the returns from your business? How quickly are your investments growing? How can you take advantage of the magic of compound growth?
Now, leverage is the practice of using borrowed money to magnify potential returns. So take something, for example, like real estate. Let's say you have some extra money, you want to buy a couple of investment properties to rent out. And let's say you have $100,000 in capital in order to do this. Now, you could potentially take that $100,000 and invest it in one property. So nice substantial down payment, your monthly payments on that property are going to be relatively low or lower than they otherwise would be. That would be fine. But you could also take that $100,000, split it into 5 down payments of $20,000 apiece, and you could buy 5 properties instead of just one. So if things work the way you want it to, you're making money on 5 properties instead of just the one. So you have the opportunity to make, assuming all the properties appreciate at the same level, 5 times more money with the same amount of investment capital. But here's the trick. If things go sour and the properties depreciate, so they're less valuable over time instead of more valuable over time, you're not just losing money, you're losing 5 times more money than you would have otherwise, okay? So by taking out 5 mortgages, you're basically borrowing more money. And by borrowing more money, you're giving yourself more opportunities to either make or lose more money in the same proportion. So leverage, you can think of as a form of financial amplification. You're increasing the amount of money you're borrowing, you're taking on more risk, you either gain more or lose more in the process of doing that. So using leverage is, you could call it the business equivalent of rocket fuel. It will either propel you to amazing heights or it will blow you up catastrophically. So it is a very risky thing that can pay off if the world goes right for you. But you have to really, really know what you're doing, or really, really have some information that other people don't have. Or let's say you have already done very well in a business and you can assume the risk of a catastrophic loss if things don't go your way. So if you're sitting on $10 million in your bank account and you could absorb a loss that's huge, you have a greater opportunity to use leverage because even in the worst case, you're still going to be okay. There was actually an interesting case study. Mr. Donald Trump has lived the ups and downs in leverage for decades now. And sometimes he's flying really high, and sometimes he's flying really low. And an interesting anecdote, there was a documentary filmed a couple years ago called Born Rich, which profiled the lives of the sons and daughters of a lot of very high society, very wealthy folks. And in the documentary, Ivanka Trump tells the story of she and her father walking out the door of Trump Tower in Manhattan, and Donald looking at a homeless person on the street and telling Ivanka, that person has more money than I do right now. Because it was at the bottom of the financial crash, and he was leveraged to the hilt, and everything that he was leveraged up on was underwater. So it can either really work for you or really not work for you. On the whole, this ends up being a matter of your appetite for risk and your ability to be emotionally okay if things don't go your way, and physically okay if things don't go your way. So it's a tool that can be used, it can benefit you. Know the risks before you do something like this. And that's what happened in the recent real estate crash. That's what happened to a lot of property speculators. They were leveraged to the hilt across multiple properties. They ended up losing more than they invested. So the moral of the story there is be careful. Be very careful.
Leverage. Questions for reflection. Does leverage make sense for your particular business idea? What opportunities might leverage open for you, given your current situation and goals? If you choose to use leverage, how can you protect yourself in the event your investments decline in value?
Now, in starting some businesses or operating some businesses, Sometimes your idea requires some capital that you don't have right now. So if you need to tool up a production line at a factory, you probably don't have $1 million just sitting around in your bank account. So there may be some times where you need access to capital that doesn't come from you. And usually, this is a relationship that relies to getting funding from outside folks, either in the form of loans or in the form of investments. And the general rule is, think of funding like a ladder. It's a hierarchy. The higher on the ladder you climb, the more money you can typically raise, but the more control over your business operations you give up to get access to that capital. So start at the bottom, personal cash. Money in your wallet, money in your bank account, you can spend however you want. Nobody can control it. It is your decision and your decision alone. It's quick and easy, great. The next step up the ladder from that is personal credit. So using your credit card is largely the same thing, and as long as you can make the monthly payments, you can do whatever you want. Now, a personal loan is, let's say you go to the bank and say, I want to borrow a couple $1,000s. If it's a small enough loan, and the bank looks at things like your credit rating, they may say, okay, we believe you're going to pay us back. Here's the loan. Have fun. And please pay the statements when they come due. If you want a larger loan, they'll say, okay, but we need some form of security that you are actually going to pay this back, which is when they ask for things like collateral. It's called a secured loan. So they may ask you to sign a paper saying, if you don't pay it back, we take your house, or we take your car, or we take some other valuable piece of property that you have at your disposal. A bond is a way of businesses selling debt against their future earnings. So I promise, if you give me some money now, we're going to pay you back that loan with interest over time. So they're not necessarily giving up much control over the business's operations, but they're predicting that they're going to be able to pay that loan back with interest in the future, which constrains their operations a little bit more. The next step up from that is what's called receivables financing. So you can go to a bank saying, we need a couple $1 million of financing for our business. And the bank will say, okay, we'll make you a deal. You hand over the control of the receivables of your business to us, and we will give you this line of credit. And as long as you are able to pay back this loan on a timely basis, we're good. However, if you're not able to pay back this loan, the bank, since they're managing their receivables, make sure the bank gets paid back first and everybody else gets paid back later. So you're getting a large amount of capital, but you're giving up a large amount of control of the business. After that, you start getting into things like capital, selling off portions of your business in exchange for equity. So the first level of capital is what's called an angel investor. It's typically an individual with relatively deep pocketbooks that is willing to cut checks of somewhere between $10,000 all the way up to maybe $1 million at the highest end. And they're just an individual investor. So they cut a check, you give them a percentage of the business. If you want ever larger checks, you're going to have to look at larger investors, and that's when you start dealing with folks like VC firms. So lots of investors with lots of money pooling their capital, and they're willing to cut checks for sometimes tens or hundreds of millions of dollars if you give up a significant stake in the business.
Is the only difference between angel capital and venture capital the amount of money and amount of your company you're giving up?
You know, it really varies. There's all kinds of angels out there, and with different expectations and different senses of purpose, depending on what kind of project you're doing. So it really depends, but for the most part, you know, a VC is going to definitely be looking for more of a, once you get to a VC, when a VC is investing, the expectation is, you know, they want a 30x plus return.
Yes.
Okay, which seems like a gigantic number, but that in fact, that's the expectation they have.
Yes, and if they don't believe that you are the person to get them that 30x return, you've given up enough control of your business that you're not going to be there anymore. So as the founder, you can have access to potentially tens or hundreds of millions of dollars if you're willing to take the risk of, if things don't go well, you may be out and somebody else may be in. The ultimate part of this is what's called a public stock offering, an IPO, taking the company public. So in that case, you are getting massive amounts of capital from the sale of your stock to the public, but you are giving up massive amounts of control over the business, because whoever owns the most shares, publicly traded, anybody can get them, Whoever owns the shares controls the board. Whoever controls the board controls the company. So you see this progression, lower amounts of money, but you maintain control. The more money you request from outside sources, the more control you give up over the operations of the business. So a similar lesson here in terms of leverage. It can be wonderful to work with VCs. It can be wonderful to work with angels. It can be wonderful to get receivables financing if you go into it with your eyes wide open and you understand the benefits and you understand the risks. So angel and VC investing could be like a whole weekend course in and of itself. There is a book that just came out. It's called Venture Deals. One of the co-authors is Brad Feld, who runs a major venture capital firm in Boulder. If you're interested in the ins and outs of how financing really works, that would be the best place to start.
He is
Brilliant guy.
The hierarchy of funding. Questions for reflection. If financing would be useful, how much control over your business would you have to give up to obtain that funding? Are you using financing to purchase force multipliers, or are you spending borrowed funds on things that are better paid for with cash?
Three more ideas very quickly, one of which we already alluded to. Bootstrapping is the art of building and operating a business without funding. So this whole hierarchy of funding thing that we discussed, sometimes your goal for the business may not be to run it to make the absolute maximum money that it possibly can be, which someone like an angel or someone like a VC will look at that goal and say, that's nuts. If that's your goal, I don't want to give you any money. So if you are running a business for other reasons, a lot of times it is helpful for you to plan to operate the business out of your own personal cash and out of your own personal credit. Because if you do that, you don't have to give up control. You can run the business any way you see fit. You don't have to please a board of directors. You don't have to please anyone aside from the basic calculus of maintaining financial sufficiency and making sure it's worth it for you to keep going. That's it. So personally, I recommend when you're starting a business, bootstrap as far as you can go. Try to get financial sufficiency as quickly as you possibly can, and then make a determination. Is what you want out of this business to continue growing it? And to do that, are you going to need to take on outside funding? Or would it make you happier and more fulfilled to maintain control of the business and do whatever you want to? That's a very personal decision.
This goes right into getting the minimum viable product so that you can have real revenues so that your actual offering has value.
Exactly. Yeah, so even if you ultimately do take on funding, you are in a much better situation to take on funding if you can prove to an investor or prove to your bank, I'm already making it. So your risk is reduced, therefore you can give me better terms. And a lot of times, VCs or angels will actively seek out bootstrapping entrepreneurs and say, hey, I would love to give you millions of dollars. And the entrepreneur says, I'm not interested. I don't need your money. I'm making money. I'm well beyond my point of sufficiency, and I would rather maintain control of this business. I don't need your investment. So yes, my personal preference is that I like to bootstrap my businesses because I like to have control over the operations. All sorts of different ways to do it. In general, bootstrap as far as you can go because it puts you in the best position, whether you want to keep bootstrapping or you want to take on funding.
Bootstrapping. Questions for reflection. Is it possible to bootstrap your business idea using only your personal cash and credit? If not, how much funding do you need, and how can you raise that money while minimizing the control you give up?
Two more ideas. Return on investment. Talked about a lot. So return on investment, or ROI as it's commonly abbreviated, is the value created from an investment or time or resources. So how much did I invest? How much did I benefit? And it's usually expressed in percentage terms. So if your ROI is 0, it didn't return anything, right? If your ROI is negative, you lost money. If your ROI is 100%, you doubled your money, and it goes up from there. So looking at ROI numbers is useful because it helps you compare different opportunities or evaluate different strategies along the same metric. So if I have 3 different lines of business and my ROI for one was negative, the ROI for the second was neutral, and the ROI for the third line of business was positive, it allows you to make some very informed decisions about where to continue investing your time, energy, and resources. Now, the return on every investment is always related to how much that investment costs in the first place. So in the personal MBA, when I'm going through my critique of business schools, most of what I'm criticizing is the high upfront cost of that, and both the direct and the indirect costs and what people have to give up in order to go to graduate school in business, right? The less you spend up front, the higher the ROI is going to be if that thing works out. Now, it's important to also remind ourselves, every single ROI calculation is a semi-educated guess if it deals with something about the future. The cash is not in the bank until the cash is in the bank. So you can make some projections, you can make some forecasts based on things that you have seen or trends or patterns that you have noticed. But if you're projecting a future ROI, it's just that, it's a semi-educated guess.
Return on investment. Questions for reflection. How can you calculate the return you're currently receiving on each of your investments? What could you do to improve that return?
Last idea. One of the most psychologically challenging ideas in all of business. Sunk cost. Sunk costs are investments of time, energy, and resources that can't be recovered once they're made. And continuing to invest there is a waste. So in general, when you're evaluating an investment, it doesn't matter how much time, it doesn't matter how much money you have put into an idea. Could be potentially billions or trillions of dollars. If it's not worth the required additional investment in the future to get the result you're looking for, it's not worth it, period, no matter how much you have invested. I tell the story in the personal MBA about sunk cost about my grandfather, Nathan Kaufman, who ran a construction company in Akron, Ohio, shortly after World War II. And he was building an apartment building, ran into an unexpected difficulty. The site that he had chosen to build the apartment building was blue clay, which is very unstable, would not support a building of that height and weight. And so he had a choice. He'd invested a whole lot of money, and he could either continue to invest an uncertain amount of money getting rid of the blue clay completely so they could build, or he could walk away. So lose the money or continue to invest. And because he had invested so much money, he continued to invest, because it would be a shame to lose all of that time and all of that money. And I was listening to my dad tell me this story, and he said he was a teenager at the time. And the hole that they had to dig was all the way down to bedrock. And he remembers a line of cement trucks just passing one right after the other for weeks, filling up this effectively bottomless pit. Because they had to excavate all the blue clay and they had to fill it all the way up with concrete to build this building. And Grandpa lost a tremendous amount of money. Basically, the building ended up being about 3 times more expensive than it was worth by the time it was done. And the error there was not taking the time to look at a sunk cost calculation, because it didn't matter that Grandpa had already invested so much into doing the thing up to this point. The real matter was, based on what I know right now, is what I'm going to be required to invest to complete the project going to be worth it when it's done? And in the end, it wasn't. And so sunk costs are very easy to understand rationally, right? If you're going to have to invest a whole lot and it's not going to be worth it, then yeah. Logically, it's not a good decision. Emotionally, because of loss aversion, we hate to lose. It feels like the wrong thing to do. And so we stay. People have a hard time walking away even when they should walk away. In reality, there's nothing you can do to get that money back, right? So Grandpa had a hole in the ground in Akron, Ohio, regardless of whether or not he chose to continue. The course of action would just be different. So it's important to understand that in every business, you're going to make mistakes. There are going to be some things that you're going to invest in, it's not going to be worth it, and you're going to face a choice. Do you continue doing what you're doing, or do you stop? And the lesson of sunk cost is, don't base that decision based on what you've already invested. Base that decision on how much more you're going to have to invest in order to get the result.
Which is why it's always good to have somebody else.
Somebody who is not emotionally invested to act as an advisor there.
Stuck there You need someone else.
And it's not the funnest story ever, but it is a literal example of the old adage, don't pour money down a bottomless pit, right? If it's not worth it, move to something else.
Sunk cost. Questions for reflection. Are you throwing good money after bad? Is the additional investment worth the reward, or are you trying to salvage an investment gone wrong? What could you do if you decided to cut your losses and do something else?